There we go.
There we go.
Hey, the Google Meet thing is on. I need to turn that off because somebody's like, are we on Google Meet?
I know. It always, for some reason, always comes up on the
I wish
invite.
it wouldn't do that.
Yeah, it's weird.
And it just stinks. That I wish it would just be like that you can either click it if you want it, because I've had that happen on interviews. People are like, I sat in Google Meet. I'm like, I don't do interviews through Google Meet. So yeah, Anastasia's like, hi, I'm on Google Meet.
Hey,
Hey.
happy Friday. Yay.
Yay. Come to the office, Anastasia.
I can't. I have a little dinosaur rugrat that no one can watch this afternoon. So
Oh, goodness.
Dinosaur rugrat, you're hilarious. I'm gonna say everybody mute yourself, Sherry. I'll mute myself too.
Okay, I got permissions to share. Okay, perfect. All right. Is everybody on, Courtney, that needs to be or should be on that we're aware of? Is there anybody that we need to ping and just see? Okay, thumbs up. Okay. All right. Well, good morning, everybody. I know you're all on mute, so I don't expect to, hear a response. It's okay.
Good morning.
Hey, it's okay. Thank you. So just to set the call up a little bit, it's me. I'm Mike. For those of you that don't know me, most, I think, if not all of you know me, but Sierra, hi. We haven't officially met, I don't think, but we've talked over some chats and things. And hi, Sabina and Tara and Taylor. I know Sherry very well, my bowling partner, and of course Gabby I know as well, Anastasia, and Howard, of course, I know, and Bridget, and of course Courtney, but just kidding. Good. So nice to see all of you here. Kyle, my teammate, is also on the call. So both of us are going to be handling this training today. I'll be doing probably the bulk of the talking here, but Kyle will chip in at certain points. But the purpose of our time today is to do some training on two things. And for those of you that have been with the group for a while, Kyle and I were in Delray physically a few months back, and we did this training in person. And some of you didn't have the opportunity to be there, and some of you weren't with the company yet. So this is just an opportunity to experience this. And the course material is very simple. It's going to be one, a really high level overview of loan programs. I'm sorry, my dog is driving me crazy. Hang on one second. Hey, you stop being a spaz. Okay. So it's just going to be a real high level overview of loan programs. And look, I want people to ask questions. Just know that this training could be literally weeks long if we got really detailed. I'm more than happy to answer as many detailed questions as you have, but I kept it high level, one, for time, and two, because I don't want to lose anybody getting in the weeds on stuff, okay? But again, happy to answer any questions about anything that you want to drill down on. And then the second thing is, this is probably the question I get the most. So we'll talk about this. It's like, how do I introduce the lender? How do I do this? Like, what do I say? How do I do that part of it? So we'll talk about that as well. We have an hour and a half. Yeah, go ahead.
Somebody, Juan said he's in the lobby. Or do you see anybody in the lobby that's waiting? Or Bridget, do you see anybody?
No.
Okay, he's in the wrong lobby.
Yeah, he's in the wrong lobby. He's not on this call. I just looked at the list. Anybody have any questions or thoughts before I get started here? Okay. All right, let me share my screen with you all. Give me 1 second. So the first thing we're going to talk about is we're going to talk about mortgage program highlights. All right. And for those of you that were on the Q&A call yesterday, I touched on a few of these items. But we're going to talk about it again because it's really apropos to timing here on some of the loan amount changes and things like that. Share screen. Okay. Can everybody see my screen here? Give me a thumbs up if you can. Yes. Okay.
Yes.
So I'm going to, thank you. So I'm going to talk through this, and if you have questions, guys, just either take yourself off mute and you can interrupt, or you can type something here in the chat and I'll stop and I can answer it. Okay. So we're going to talk about, look, there's lots of different loan programs, but we're going to keep it to the most popular ones. You've got conventional loans, FHA, VA, and jumbo. All right. Again, there's other programs that we could certainly talk about, but for the focus of this conversation, that's what we're going to start with. Are we free to take pictures of the material you're sharing? Yes, Sierra, absolutely. And by the way, thank you for saying that. I'm going to be sending this out to you all in an email, you know, as a PDF, so you'll have it and you could save it. Okay, thanks. All right. Thank you, Sarah. That's a great question. Okay. So first is we're going to talk about conventional loans. You know, for those of you that are actively doing lots of transactions, you know right now that conventional, for whatever reason, is the cream of the crop. Like listing agents only want to see conventional pre-approval letters, right? We all know this. So let's start there, and I want to dive into this. Now, as of last week, the maximum loan size for a conventional loan was $548,250. Okay, as of yesterday, the Fannie and Freddie announced that the maximum loan sizes are going up to $647,200. So almost a $100,000 increase, which is a real testament to what's going on in the housing market right now. This is all based on the average home prices. So prices have gone up so much that Fannie and Freddie are forced to increase these loan limits in a significant way. The minimum credit score for a conventional loan is a 620. Conventional is very what I'll say is unforgiving on lower credit scores as it relates to the interest rate and the cost of your mortgage insurance. So, we had this question yesterday by, I think, Shelly on the Q&A, and she said, "Hey, listen, Mike, like my borrower can qualify for a conventional because I know their score is 630 or something. Why didn't it go that way? Why is it FHA?" Well, because like I said on the call, and I'll talk to you about here in a second, when I get to FHA, there's probably a $200-300 difference in payment by doing a conventional loan with low scores versus an FHA. Okay. The mortgage insurance premium for a conventional loan is based on the credit score. That's what's unique about that. If you do an FHA loan, it's not. Okay. So that's a big thing too. Minimum down payment is 3%. Get a little bit better loan terms if you put 5% down, but you can do 3%. If the borrower puts 20% down, they do not have to pay mortgage insurance. Does everybody know what mortgage insurance? Well, is there anybody that doesn't know what I mean when I say mortgage insurance? Should I explain that for just a second? So, okay, so mortgage insurance is only protecting the lender, right? The lender is at risk. So the less money that a borrower puts down, the more of a risk it is to the lender. Why? Well, if the borrower defaults, right, and lenders look at everything as what's worst case scenario here, right? Because it's based on risk. If the borrower puts down, let's say 3%, they don't have a whole lot of skin in the game. right? So if they run into some tough financial times, there's a much higher likelihood that they're much more willing or easily can walk away from this, mortgage and stop making payments versus someone who put 20% down. Someone who put down a 20% or larger down payment doesn't want to lose that money and doesn't want to walk away. And they'll usually find a way to make those payments or figure something out, right? So because of that risk, lender adds what's called a mortgage insurance premium that can be paid monthly or as a lump sum. It's generally paid monthly in the mortgage payment every month. Okay. So we advise folks all the time, look, if you can, get a gift from a family member for the 20%, or if you got it on your own, it's always in your best interest to put 20% or more down, just because it'll save you some money. And that money does, the payments that you make as a borrower for the mortgage insurance do nothing to protect you as the borrower. Okay. But look, not everybody, is going to be able to do that. And so certainly we do a lot of loans with less than the 20%, but that would be ideal if they can. The borrower can remove the mortgage insurance once the loan to value gets to 78% or less. So that's good, right? So we tell people that too. Now that is specific to only conventional loans. And I'll explain that as we go further here for FHA. Maximum DTI is 45, but very often we can go to 50%, assuming the borrower has a good credit and low debt to income ratio. So very often we can, sorry, turn my phone off here. So very often you can go to 50%, which is great. Again, FHA, you can go higher. I'll talk about that in a second. Seller concessions. So the seller can contribute up to 3% of the buyer's closing costs. You can do higher if you have a higher down payment. But if it's a 3 or 5 or 10%, or if it's a 3 or 5% down payment, the seller can contribute a maximum of 3%. And then 2% is the maximum for investment properties, no matter what the loan to value is. Also, on conventional loans, there's a possibility of getting appraisal waivers. We're seeing these quite a bit with good scores and larger down payments. So what that means is there is no appraisal required on behalf of us, the lender, to approve their loan. Saves them money. Appraisal's $500 something bucks, right? And it saves us time, right? Appraisals are taking a couple weeks minimum to get in because everybody's so busy. These appraisers are backed up. So that's certainly an advantage if that can happen. And you can do a conventional loan on all types, primary, secondary, and investments. Again, we could go really deep on this, but those are what we felt were some really high level important facts to know. Let me stop right there and let me open it up to some questions.
I have a few, sorry.
Sure.
Talking about appraisal waivers, does that apply to all types of residences? So like if you're buying a condo, and you're going conventional, can you still do an appraisal waiver?
You can if the borrower qualifies for it. So it's not specific to the property type.
Okay, perfect.
It is specific to, it does have to be an owner occupied residence or a second home. Can't be an investment property. You can't get a waiver on an investment property.
Okay.
And typically you need good credit and 20% or more down.
Okay.
One caveat I'll tell you, the other piece of this is, this sort of gets run through this automated system through Fannie and Freddie, right? And Fannie and Freddie, just so we all know, those are the government entities who insure these loans and they create these loan guidelines, right? Who we sell them to. So what I've seen is if the property is in a bit of a rural area or an area that doesn't have a lot of data tied to it, they won't issue an appraisal waiver no matter what the circumstances are, just because they may not have the proper data to determine what they think that value is.
Okay, cool.
You guys are probably not doing stuff in areas like that, but I've seen that before, so just thought I'd mention.
Thanks. And then are there any benefits of paying PMI as a lump sum?
Yes. The only real, well, maybe. I've done it a few times, and for two reasons. One is if the borrower's just like, hey, listen, Mike, I'm not comfortable with my monthly payments. I'd rather essentially like buy out or prepay the cost and then keep my payments low. That would be a reason to do that. So I had a transaction. Now this is going back probably a year now, but the buyer's mom said, hey, listen, like I want the payment to be as low as possible. I'll give them a gift for whatever it was, the $5,000, or I don't know what it was, for the lump sum to buy out their mortgage insurance, and that kept their payment low. The other reason would be, if the borrower's really tight on debt to income ratio. So I had a situation this is 6 months ago probably, but long story short, but the insurance came in higher because of some nuance that nobody knew about, and so it pushed the borrower over the qualifying ratios. So the only thing that we could do, and they had no debt, so the only thing we could do to lower the ratios and get the loan approved was to buy out the mortgage insurance and bring down the debt to income ratio, and that was a way to get the loan done. That was a premium listings deal, by the way. I think that was.
Okay, and I have two more. Can you finance it? Can you finance, I guess, a lump sum PMI? So as long as it's within the seller concessions percentages?
Yeah, sure. So I think I'm answering your question, but yeah. So the lump sum mortgage insurance is considered a closing cost. So seller concessions can go towards that. Is that your question?
Yeah.
Okay.
And then lastly, for FHA, what is PMI based off of? Is it based off of just down payment?
Yep.
All right. Thank you.
Just down payment. Yeah. And we'll talk about that in our next section here. But that's a great question. Kyle, thank you for answering Howard's question on the chat line. It says, how is the appraisal paid for? So the appraisal is paid upfront by the buyer. That's the only cost they pay for upfront. Everything else is paid at closing. And it's paid for upfront except for a VA loan. Thank you, Kyle. A VA loan, the borrower is not allowed to pay for it upfront, but assuming the loan goes through, they do pay it at the closing. Okay. And once they make the payment, then the appraiser goes and gets the order scheduled with the parties involved. So far, so good. Anybody have any other questions before I move on here?
Yeah, quick question. So
Yeah.
to get the appraisal waiver, what does the buyer need? Just a higher credit score and a lower debt to income, or?
Yeah, it's a bit of a subjective answer because it's a subjective process. There's like this, algorithm that Fannie and Freddie have built into their automated underwriting system that we pull. And it's, they look for the area, the amount that they're buying it for, the borrower's credit and debt to income profile, and they determine it based on that. So we honestly don't know until we run it. What I will say is, unless they're putting 20% or more down or they have a really good score, you probably don't get it. I'd say we get appraisal waivers on about 20 to 25% of our deals.
Anastasia, we have the capability to plug in a property address into someone's pre-approval application and run it through the automated underwriting system for Fannie Mae or Freddie Mac to see if it's going to qualify for an appraisal waiver before we even submit the loan for processing. So that's one thing that we can, do to try to see in advance if it looks like it's going to get a waiver or not. Like Mike said, it's tough to know in advance because I think number one right now, because values continue to increase, there may not be data to support, putting applying a waiver because, oftentimes the appraisals are looking at historical data from, 30, 60, 90, 6 months ago. And with values continuing to go up, they may not be able to feel comfortable that the value that somebody's willing to pay for a property right now is where the market's at, without doing a more in-depth in-person analysis through the appraisal appointment. But if you happen to get into a situation where somebody's looking to sell fast, and so they're taking a deal that might be slightly below market, which might line up with what other houses have been selling for, then you might get lucky and trigger a waiver if they've got a good credit profile and debt to income ratio and down payment. So
Got it. Thank you.
yep, no problem.
Thanks, Kyle. Thanks, Anastasia. All right, I'm going to move on here. FHA loans. So as I said before, the FHA loan limits have also gone up. So the minimum, so in like low area counties now, FHA loan limits are based on county. In low area counties, the FHA limit is always 65% of the conventional loan limit. Okay. However, because and I use this Palm Beach County as an example because we do a lot of transactions in Palm Beach County, and I know most of you do a lot of work there. The minimum, the maximum loan size in Palm Beach County is 460 for an FHA. And by the way, that's up from 402, which is what it was recently. Now, one thing to note on this 460 goes into effect January 1st. So we do have a few more weeks before that goes into effect, but because it's happening here January 1, I figured I would update this accordingly for you. Okay. Minimum credit scores of 580. I will tell you anything below 620 is much more challenging to get approved. So I like to set those expectations. It's also considered what's called a manual underwrite. And a manual underwrite is anything below a 620. And it's got a lot more restrictions around debt to income ratio, credit, collections, charge-offs, things like that. So, what we try to do is if someone's in that 580 to 619 range, we try to work on their credit a little bit for them and bump their scores up to 620 or above, because it makes it much easier to get approved. And there's much better loan terms as well. So 620 and above is ideal. By the way, just so we all know, every 20 points, this is true for all loans, every 20 points a score goes up, it improves their rate or their loan terms. So, a 620 to a 639, it's the same pricing. But once you get to 640, it changes, right? It gets better. Or 679 to 680. I actually had, it's so funny, I had a client who came to me last month, and they had a 679 score, and they were quoted a higher rate from their bank. And I said, listen, yeah, well, my rate would be that with a 679 score. I said, let me run a program and tell you how we get you down to, or, up to a 680. So the guy just had to pay $100 towards his balance of a credit card, and I got his score up to 680, and I improved his credit or his rate by 0.25%. No one thought to tell him that. So anyway, those are things that we look at every time we talk to the buyers. FHA is much more forgiving on credit scores for interest rate purposes. Again, FHA is designed for that first-time home buyer or buyers with like challenged credit, down payments, and high debt to income ratio. Okay, that's what it's for. All right, so they're much more forgiving on credit score and debt to income. The minimum down payment is 3.5%. So the mortgage insurance is the same regardless of the credit score. So I forget who asked me that question earlier. Maybe Sierra, I can't remember. But a 30-year fixed mortgage insurance premium is 0.85%, assuming the buyer puts down 3.5%. So what that means is if the buyer does an FHA loan, they put 3.5% down, which is what almost all of them do, right? That's the minimum down payment. They're doing an FHA loan here for a reason. They have to pay 0.85% as a mortgage insurance monthly premium. So just to use easy math, if they're doing $100,000 loan, that they have an $85 a month mortgage insurance factored into their payment. Okay. The one caveat with an FHA versus a conventional is that the mortgage insurance is for the life of the loan on an FHA. Even if you put down 20% or if you pay it down to 78 or whatever, you have to pay mortgage insurance for the life of the loan unless you refinance into a conventional loan. So if there's any downside to an FHA loan, it would just be that. Otherwise, there's many positives to an FHA loan. Frankly, FHA loans are much easier to qualify buyers for because of the more forgivness around scores and debt to income and things like that. Maximum DTI, debt to income ratio, is 56.99%. So as I said on conventional, it's anywhere from 45 to 50. It's 56.99 for an FHA. Not in every case, but in most. And they have to have a 620 score or higher to be able to get that high. Okay. A seller can pay up to 6% as opposed to 3% on the conventional towards the closing costs and prepaids. And again, just to delineate that, seller concessions can only cover closing costs and prepaids. But when I say prepaids, I mean like when a borrower sets up an escrow account, right, for the insurance and taxes. It can't cover down payment. Okay, so that can only be the amount of the closing costs, right? There's no appraisal waiver option on an FHA, and it's for primary residences only. Okay, questions? Let's stop there. Anybody?
I don't have a question, but I want to mention that it's very infrequent, but if somebody puts down 10% on an FHA loan, they can get rid of mortgage insurance, but it takes 11 years for the mortgage insurance to go away. And most people that are doing FHA are not putting down 10%.
Yeah.
So for all intents and purposes, the mortgage insurance essentially is for the life of the program, unless they're putting down 10%, which is extremely rare, just FYI.
Great point. Thanks for sharing that, Kyle. I've never done it.
Wait, Kyle, can you repeat that again, please?
Yeah, on an FHA loan, if the buyer is putting down 10%, the mortgage insurance will go away after 11 years if they still have the mortgage for that long. So technically, mortgage insurance is not always for the life of the loan, but the likelihood of somebody putting down 10% on an FHA loan is very, very slim. Mike's never done it. I've never done it. But technically, if they put 10% down, they can get rid of the mortgage insurance after 11 years.
Oh, that's great. Okay, thank you.
Yeah, unless there was some good reason to do that. Because if they had 10% down, they're likely doing a conventional loan, right? Because then they can get rid of it as soon as they get to 78%. But yes, Kyle, thank you for sharing that. That is correct. Any other thoughts or questions or feedback on the FHA stuff before I move on?
So with the 10% down, just to recap there, the only reason they wouldn't be able to go through conventional would be, I'm assuming their DTI or their credit scores aren't high enough.
You want to take that, Kyle?
Sure. Yeah, I mean, those are probably the two most likely reasons why somebody would do, an FHA loan as opposed to a conventional loan. Because, if they have a 10% down payment, then naturally we would normally think conventional, of course, because, they have such a, more than the minimum down payment requirement. But, if their debt to income ratio is low, as you can see on FHA, you can go up to 56.99% in many cases. And, credit wise, you can go as low as 580, although it's not recommended because it's very, very difficult to get somebody approved at a score below 620. So if they already have a 620 credit score, that's the minimum for conventional as well. So again, if they have 10% down and a 620 score, chances are we're going to recommend that they go conventional because the mortgage insurance will probably be cheaper on a conventional loan, even if their credit score is just barely over 620. And even though the maximum debt to income ratio on a conventional loan is typically 50% and FHA is 56.99, that's probably close enough with the difference in the cheaper mortgage insurance on the conventional loan, where we would just put them in a conventional product, which I assume is why Mike and I have never done an FHA loan with 10% down. It's just very unusual that somebody would need to do an FHA loan still at that point where they have 10% down and a minimum 620 credit score. So,
Right, that makes sense.
I'll give you one other thing to think about on that, or just to note. FHA is much more lenient as well on prior, like foreclosures and bankruptcies and things like that. So for instance, if a borrower, and I'll just use, an example here. If a borrower had a prior foreclosure, there's a 7-year wait period to do a conventional loan again, but there's only a 3-year wait period if they do an FHA loan. So that might be a reason why that could happen too. Again, you're just not seeing a lot of that these days. You saw a lot of that between 2008 and 2013, call it, maybe even more because of the downturn. But you don't really see a lot of that now. There's not really many foreclosures out there.
Mike, you said 7-year for conventional?
Yeah. 3
Okay.
years for FHA.
Okay. Thank you.
Yeah, sure.
fair point.
Anything else before I move on?
I'm sorry, I'm not sure if this was covered. Did you guys go over the bankruptcy rules, like chapter 7 versus 13, the waiting periods?
You know
If
what?
any?
No, but you know what? I have a cool little like cheat sheet on that. I'll send that out to you guys after the meeting.
Thank you.
Because I could go over that, but it might take us over our timeline. I'll send that out to you guys in a little 1-pager. Okay.
Thank you.
Okay. VA loans. Borrower must be a veteran. Pretty straightforward. Or a spouse of a veteran, right?
Right.
By the way, they must have been honorably discharged. If someone was dishonorably discharged from the military, they do not qualify for a VA loan. But there's a lot of incredible advantages to doing an FHA loan if someone qualifies for them. There's no maximum loan amount. If they go really high on the loan, it might require a slightly higher down payment and slightly higher rates, but there's no maximum loan amount, so they can go as high as they want.
You meant on a VA loan, just to clarify. You meant
Yeah.
VA
What did I
loan.
say?
FHA.
VA. Thank you.
Yeah, VA loan.
Appreciate you keeping me in line here. A VA loan. Yes. Thank you, for a veteran. Same with an FHA. A VA is more forgiving on credit score as it relates to interest rate purposes. Typically, the VA and FHA are really aligned in rates and loan terms based on scores. But VA allows 100% financing, and there's no monthly mortgage insurance. So that is a huge benefit for our veterans. Listen, one of the biggest, if not the biggest, obstacles for any type of home ownership is down payment money, right? I mean, that's very often the biggest obstacle. Well, it's not an obstacle for a veteran. Maximum DTI is 50, but if the borrower has a good credit profile, we can go much higher than that. I closed a VA loan with a 67% debt to income ratio last month. Kyle's closing one actually today, I think, for Katerina. That's I think at like a 57 or something. So we can certainly have a lot more flexibility for our veterans on those types of loans. Interestingly, a couple other lenders and banks turned those deals down, and they called us and we got them done. So sometimes those lenders and banks don't think about how, how flexible VA is, or that they might have overlays or something that would prevent them from doing it where we don't. Anyway, the sellers can contribute up to 4% of the sales price towards the closing costs and the prepaids. So listen, I know concessions are tough in this market, guys. I get it, right? I know what you go through every day. But hypothetically, if you do a VA loan and the seller contributes 4% to essentially cover all the closing costs, in most cases, it's 0% down. So it's 100% financing. Hypothetically, the borrower doesn't have to bring much or any money to closing, unless it's one of Howard's clients and they don't want to bring they don't want to pay the earnest money deposit, right, Howard? They do have to pay the earnest money deposit to sign the contract. So anyway, we had a deal like that. It was a great deal. The buyer wouldn't put the earnest money deposit down. But anyway, but yeah, fantastic opportunity for the veterans. There is no appraisal waiver option. Appraisals need to be ordered through the VA portal. I tell you that because it's a bit of a different process and it can typically take a little bit longer. We have no control, no lenders do have any control over the VA appraisal process. We all place the same order through the VA system, and they have 2 weeks to get the report back to us, and they take every bit of 2 weeks every time to get it back to us. So you can set those expectations with the borrower if they ask. Primary residence only on a VA, and something that's unique to only a VA, but a very important piece is VA loans are the only loans that require a termite inspection. So for all of you on the other side, the agents up front, that when you're negotiating these deals, you're getting these buyers, under contract as the buyer's agent, very often you're involved in setting up the inspections for the buyer. It's crucial that if they're doing a VA loan, make sure that you're, making sure that they also order a VA, the inspection for termites, as well as the 4-point inspection and usually a wind mitigation. But make sure that the termite is added in there, because if there's termite damage, that always has to be remedied before the closing. Kyle and Katarina are doing one of those right now. The termites ate through like all these boards in the attic, and they were dust, like no boards left. I mean, it's crazy. But anyway.
And Mike, do the sellers take charge of that for the termite inspection?
The termite inspection specifically has to be paid for by the seller. Cannot be paid for by the buyer. Thanks for thank you for the reminder on that one. That's a good thing to add.
Thank you, Mike.
Of course. Questions? VA loans. What you got? Thoughts?
They're great.
They are great. Isn't it funny that sometimes it can be a little more difficult sometimes, right? As buyer's agents to get a VA loan under contract for some reason. Gosh, if I was a listing agent, I would say, geez, here's a veteran. I don't care if they're putting no money down. They qualify for a VA loan. They served our country. Like, I would want to prioritize that. But, sometimes it doesn't work that way on the listing side for
Right.
whatever reason, unfortunately. But anyway. But they're fantastic for the buyer.
On my deal with Katarina, the listing agent specifically liked presenting VA loan offers to their clients. I don't know if it's because he wanted to sort of have that reputation, amongst the industry as being, friendly towards VA or whatnot, but they actually accepted our mutual client's offer with a VA loan, no money down, over other, competitive offers, specifically because of the fact that they were qualifying for a VA loan. So in some cases, it can actually work to your advantage, like it did with, Katarina and my, client. So, I know it's hard to, think when you're presenting an offer that has no money down, that it's not a great offer, but in some cases it might be the perfect offer they're looking for. So.
Any thoughts on BA? Any other questions? What's up, Kyle? Just saw that you were on the call. Kyle Can. How you doing, bud? Okay.
How's it going, Mike?
Hey, man. Nice to see you. Sabina, any questions? We haven't heard from you yet. Just anything that you have a question about or that we could, expand on for you? You're on mute if you're trying to talk, Sabina. Anastasia, did you want to mention something?
No,
Okay.
I'm good. Thank you.
Okay, cool. All right, I'm going to keep going here, guys. Jumbo loans. We'll talk about jumbo loans. I could just speak personally. We're doing a lot more jumbo loans over the last year or so than ever before, simply because of what we talked about with the increasing home prices and all the move up buyers. Right, these folks are saying to themselves, "Geez, I can work from home now." And if I do work from home and I spend literally my entire day here, I want to live in a really awesome house. And so a lot of these folks that are, have kind of had their houses for a while are looking to upgrade. So we're seeing a lot more of these. Maximum loan size, 3 million. That doesn't mean that the purchase price can't be more than that. It certainly can. Maximum loan amount is 3 million. The minimum credit score is a 720. I believe we've softened on that to a 700 now. Certainly, the better the score, the better the loan terms. Someone buying a large home with a sales price in the millions, typically has great credit. So you don't really ever run into folks who are challenged on credit. But 10% down is the minimum down payment. Of course, if they do 20, you avoid the mortgage insurance. It's a little bit more restrictive on debt to income ratio. So it's a 43% maximum debt to income ratio for a jumbo loan. Seller concessions, you can still do 3%. If your loan amount goes over 1.5 million, likely you'll need 2 appraisals. And it can be used for primary, secondary, or investment properties. Now, I went through that a bit quickly, but what questions or comments do we have, Benny?
I mean, I'm just glad that the conventional loan amount went up a little bit because there's a take and give for that, but at least our clients are able to, combat in this challenging market, and their rates will still be a little bit lower because it's more competitive than a jumbo loan, right, Mike?
That's right. Conventional terms are better than jumbo. Listen, it's based on risk, right? So a lender would much rather give out 5 loans at $300,000 a piece, because if one loan defaults, well, they still have 4 loans that are performing at $1.2 million. If they do one loan at 1.5 million and that loan defaults, well, they have 1.5 million tied up for God knows how long to go through the foreclosure process. So it's always less of a risk, which is why they're priced accordingly. But it's not a huge difference. But typically there can be a bit more cost on a jumbo loan versus a conventional.
Right. Thank you.
Okay, before I move on to the lender introduction questions and rebuttals, are there any questions about these loan programs? Now, look, guys, we have there's a lot of other loan programs, and I'm trying to condense this into this is 95% of the loans that we do on a day-to-day basis, or that you'll see as buyer's agents. So trying to keep this to a really high level conversation, but we can absolutely do future follow-up trainings and do a deeper dive on bank statement loans or foreign national loans or investor cash flow loans that don't require any income documentation from the buyers. There's all kinds of other stuff that we do. We don't, you just don't see as much of that because it's not as, as prevalent, but they exist, and we could certainly get deeper on that in follow-up trainings, or you can, when the training's over, feel free to call Kyle or myself or Ruben or Michelle or Haley, and we can talk to you one-on-one about that. But I try to keep this as
Of course, let me know how it goes.
to focus on what you're probably going to see on a day-to-day basis. Anything else?
Perfect. Thank you.
I don't want to get too much in the weeds, but for
Okay.
jumbo loans, I remember a long time ago, there used to be something called that I had to sell, which was very confusing to me, which was like an 85, 15.5, where they're doing like a second loan and it's interest only. Is that what a jumbo loan is, or is that one form of a jumbo loan?
Great question, Sierra. And did you do mortgages in the past?
No, but when I worked for a builder, we had to do their pre-qualification and go over the loan program. So I had to know a little bit about the programs.
Gotcha. Well, that's a great experience. So we offer that as well. Okay, so the buyer can do like an 80% conventional first mortgage, let's just say, right, and do like a 647 conventional first mortgage, and then we can tack on a line of credit for like another 10 or even 15% to make it a total of a 90% or 95% total, loan. So we can absolutely do that.
But they don't have to do that. That's my question.
No,
right?
no.
Okay.
The jumbo loans that I'm talking about here is all one loan.
All right, perfect.
Okay. And there could be some advantages to splitting it up based on loan size. So for instance, I'll give you one really fast example. I did split up a jumbo loan a few months back with a client because what they were doing was they were eventually going to sell another piece of property and come into a few $100,000. So what I did was I said, okay, well then let's do the first mortgage with a lower conventional interest rate and less cost, lock that in for 30 years. I'll do the second mortgage, which is a line of credit, which is going to have a higher interest rate because it's a second mortgage, of course, right? It's going to have a higher rate. But I said, if you can pay that off in 3-4 months when you sell the other property and come into those funds, well, then that leaves you with this really low fixed rate for the rest of your loan term. And for them, like that made a lot of sense, and that was just a better option for them. So it just sort of depends on the client and what their motivation is. And that's all kind of a part of our discovery process as we talk to the client, get to know them. If that's helpful.
Very helpful. Thank you.
But that is an option, absolutely.
Right, perfect.
Anything else before I move on here? Okay, well, let's go to part 2. There's only 2 parts to this. And then I'm going to open it up to any more questions, and then we'll be wrapped up here by 12:30. I like to try to keep timing to as tight as I can to be sensitive to everyone's schedules, self included. So I get this question a lot, like, Mike, I talked to a buyer and I really wanted to get them over to you, but they said, well, we already are working with someone. So sorry. I said, okay, well, look, you're under no obligation to do that. However, I know that, most of you on this call will probably attest that you'll certainly have a better experience. You'll be in the know, better communication, usually better loan terms and better programs for the buyer. It's just funny. I was talking to, it wasn't Sherry. It was, I forget, somebody else. And they were going through another lender, and the borrower had spent all this money, and they were like 45 days, into the deal, and they missed the closing date. It was this incredibly stressful situation. and the lender was like stalling and not answering any questions. So the agent called me and said, Mike, like, hey, will you look at this? So I talked to the borrower and looked at their income. In 1 hour, I said, this person doesn't qualify. They don't make enough money. Like how are we 45 days in with an accepted contract? The borrower spent thousands of dollars on inspections, and like it was just mind-boggling. So, certainly it's self-serving a bit, but we do a lot of due diligence up front to make sure that those clients are pre-approved. We take an application, we collect all their information, we communicate to you guys in a very communicative way, and we're a phone call away or a Zoom call away, and of course you see us weekly no matter what. But so the question I get is, what do I do? How do I make an easy transition? And what are the benefits that I can explain to a buyer as to why I should introduce them to you all? So because I get that question so often, I made this short list, and a shout out to Juan. Juan uses this quite a bit, and maybe you can chime in here, Juan. But it seems like you've been really successful in your ability to do that by using these exact conversation pieces. But
Yeah, I agree. I agree, Mike. I mean, it's really just about doing your due diligence up front and saving your client a lot of time. Everybody's on the same page. And of course, I mean, I was thinking at the end, I just wanted to say thank you again to the mortgage equity partners in the Manieri team. We're very grateful to have you because, I mean, literally as I'm going through this course right now, I have other buddies that are mortgage brokers with their other companies and all that. And I'm sending them, look, I mean, that just changed yesterday, jumbo loans, conventional loan amounts and everything. And believe me, this is a great help to everybody that maybe isn't so familiar with the Manieri team or anything like that, but they're really, we're like family, and I really appreciate and I count on them a lot.
thanks, Juan.
So yeah.
Likewise.
Yeah. Thank you.
Thank you for that. So bullet point 1, there is a great value. These are things that we suggest that you mention to your buyers, when you decide to make the introduction. Number 1, listen, there is a huge benefit to the relationship, and Juan just talked about this, between the lender and the realtor, right? Like, case in point, I was talking to one of the agents on your team, and we are attempting to negotiate some seller concessions with to get this buyer to get this deal done, because they don't have a whole lot of money. But they had talked to another lender prior to us. They didn't even mention the concessions. They just said, "Oh, sorry, you're not able to get approved because you don't have enough money." And they didn't give many guidance on that. So I said, I got involved, and I said, look, well, it's certainly challenging, but there's a path forward here. And my relationship with the agent was, hey, look, if you're willing to do the work and you're willing to go out and show them a lot of properties and try to negotiate, some concessions, yes, this can work. So not only that, but I've also run all the numbers and told them exactly what to go negotiate, so they can make this deal work for the buyers, on the financing end. So again, that's just one example, but there's a lot of synergy between the two parties that really benefit the buyer. Okay, and it can create for a much smoother transaction.
Yeah, I agree on that, Mike. And just on that point too, little shout out as well. Sometime back with Michelle, we were dealing with another client, and he had a question about a first-time home buyer, right? First-time home buyer credit and programs. And he spoke with, I think, like 3 other lenders that told him, no, you wouldn't qualify, this and that. Even though, he's a little bit older and he's purchased properties before, I think it had been over 3 years. I think that's a cutoff time. Correct me if I'm wrong, to actually qualify for that program. So he was very impressed with that, and that's what got her Michelle the business too.
So we got her got them into the, into the program?
I believe Michelle's still working with him. His name is Michael Berger, but yeah, that's that was basically the catalyst to earn his business. It's
Yeah,
just
great.
relevant and correct information.
Great. Thanks, Juan. On-time closings go without saying. We miss very, very few closing dates. If we do, there's a really, really good reason for it. Like we're a day late on this VA deal with Katerina and with the Kyle, but getting somebody out to repair the wood in the attic for these termites that shoot through it, and then getting the inspector back out there to take pictures and get us a completed report was challenging at best around the holidays. So, so that doesn't happen often, but like, you gotta be able to be and to have an efficient process, right? And if you don't, you're never gonna make a closing date on time. And the last thing you want is to go past that purchase contract date, because we all know what'll happen, right? That seller will put that thing back on the market for more money, and they'll probably get it. That's the market that we're in right now. So meeting those timelines is crucial. Working with very experienced folks, Juan talked about that. I've been in the business 22 consecutive years. Kyle's over 7. Michelle is 30 plus. Our processor, Michelle, is 30 plus. Haley and Ruben, everybody's really experienced. So, you just get the right answers. We're helping Yanni with a family member, and I talked to him yesterday, and he got a pre-approval letter for his family member from some other mortgage company. I'm like, dude, they don't qualify yet, and this is why. And he's like, oh my God, thank God I freaking called you on this. So obviously they're going to change, but like, it's just like, it's just funny. But anyway, communication. If anybody knows me, I am militant on communication. I mean, it is the focal point of our existence. And we communicate tons of updates throughout the process. We're going to copy in all the folks involved. You're always going to know what's happening at any time during the process, and before the process too. When you send over a lead, like, we're going to follow up. Hey, this is what's happening. You called and left a voicemail. We didn't get them. We'll call again tomorrow. But those are things that you need to know, right? Like if Sierra sends a lead to Kyle, and she doesn't hear from him for 3 days. Sierra, tell me what you're thinking if you send a lead to Kyle and you don't hear from him for 3 days. Tell me what your thoughts are.
He hasn't done anything with the file.
He hasn't done anything. I'm not important. He doesn't care, right?
Mhm.
Well,
Exactly.
on Kyle's end, he might just be like, oh, dude, I called 5 times and they didn't answer the phone. Well, we're going to tell you that, right? We don't expect you to know that, right? Because if we don't communicate that to you, even though there's not really much of a progress going on, at least you understand that we're working on it and we're making all the attempts to get you further along here in the process. Okay. So, those things are super crucial. We're available on nights and weekends. If someone's working with a bank, God forbid, or one of these national banks or something, right? I mean, let's be honest, most of these deals, guys, are getting done nights and weekends. That's when the buyers are available to go see the properties. And you're writing it up on a Saturday night, right? Waiting to go out and go have a cocktail, but you're scrambling to get the thing out. And you got to have your lender available to get the pre-approval letter or whatever you need to get your offer in timely. In this market, if you have to wait until Monday to reach your lender, that property's gone and you've wasted a lot of time, unnecessarily. And same with the buyer, right? Like when a buyer's going through the application process, very often they have questions after work or on a weekend, and we're there to, answer them and to help them. We're like doctors. We're always on call, I say. And then, you want to work with a local lender, right? I mean, someone that works, 99% of our business, while we're licensed in a bunch of other states, I'd say 98 to 99% of our business is in Florida. Probably 50% is in South Florida. So Like we do this all day, every day. We know the codes, we know the rules, we know about homestead exemption, all these kinds of little nuances that go into lending in Florida. When you work with someone like I'll use a Rocket Mortgage as an example, right? These guys are doing loans all over the country, and maybe they've never done a loan in Florida or very few, and they're not advising the buyer in many times the way that they need to be advised. And so there's tremendous value, albeit self-serving, as I said, but there's tremendous value in working with someone that has got a local presence and does work locally for a really, really, really long time. Thoughts on that or questions? I
have a question.
Yeah, go for it.
Any programs for first-time buyers with 0 down payment?
Is that Sabina?
Yes.
Okay, hi Sabina. The short answer is yes. So I'll tell you, there's obviously the county programs, right? There's the, and they're specific to cities and counties. I will tell you that there are times when, so in most of the city and county programs, it requires 2 underwrites. It requires us to do our underwriting process and our approval process. And then the city or county or that municipality has to do their own underwrite in their own approval process. Why I mention that is because oftentimes that can expand a 30-day closing to a 45 or a 60-day closing. So while those programs exist, it can sometimes be a bit challenging to get a seller to accept it, especially when you're in a multiple offer situation or you're in a hot market. It's like, hey, why would I take that offer when I can do a 20% down conventional loan closing in 30 days? But yes, they exist. Now, I will tell you, we have our own internal down payment assistance program. Not everyone qualifies for it, but so it's based on income, credit score, things like that. But if they qualify for it, instead of it taking an extra, 30 days, it might take an extra 5 days or 10 days. So you could do a 30, maybe even a 40-day contract and feel perfectly comfortable that you have plenty of time. And it basically works like this. The borrower gets the first mortgage, let's just say it's an FHA, that they get a 96.5% first mortgage. And then instead of putting down 3.5% as their down payment, they just get a second mortgage for 3.5%, which totals 100% financing. Okay, follow that?
Yes. Thank you, Mike.
Yeah, and we can get into details as you want us to, if you have somebody that you want us, to talk to about that. Okay.
Great. I have your number.
Okay, thank you. Thank you, Sabina. And just so you guys know, I'm doing like lots of the talking here, but Kyle and Ruben and Michelle and Haley are all they're all available, but they all know all the same things I know. You can go to Slack or you can contact us directly, or you can send an email to the Manieri team at MEPLoans.com. It's also on the footnotes here of these pages that I'm going to be handing out here after the meeting. A couple quick objection and rebuttal things that I thought were kind of cool, because I get these questions a lot. Mike, I've already got a pre-approval. The response could be, I've had many experiences in which a buyer had an incorrect pre-approval. I just talked about that. Or they were put into a loan program that wasn't necessarily the best for their situation. It's always a good idea to get another quote to make sure you're getting the best loan terms as well. I don't want my credit pulled again. Get that a lot. I'm sure you guys do. Most of you know this, but I'll say it again. The credit bureaus allow the buyer to shop for a mortgage. So from the day they have a credit pulled, if they do this with a different mortgage lender, they have 30 days to have it pulled by another lender without it impacting their score at all. Zero impact. Okay. So most folks don't know that, so that would be a good thing to share with them. And if you're over 30 days, I mean, look, it's only a 1-point inquiry, so it's not a big deal. But if it's inside of 30 days, there's nothing to be concerned with. And one other thing I'll add, when we issue a pre-approval, most of the lenders and banks have like a 30 or 60-day timeline on their pre-approvals. Ours are good for 120 days. So, we don't have to go, so that buyer doesn't have to repull their credit every 30 days or 60 days or go through the process over again. So they essentially have 4 months to buy something with that pre-approval letter. If it gets to that 3rd or 4th month, we might ask them for some updated pay stubs or something, but they don't have to go through the process again.
Hey, Mike, can I add something here about pre-approvals in specific?
Yeah, thank you.
So I came from a big bank, Bank of America. I was with them for 4 years as a mortgage lender. And there's a huge difference between a pre-qualification, a pre-approval, and then a real pre-approval. So the difference really between what you get with most lenders that have pre-approved their clients is that they've taken an application. The buyer said this is how much money that they make. They said this is how much money they have in their bank account, and then they pull a credit report and now they're pre-qualified or pre-approved. The difference between what those lenders do and what we do is we actually verify everything with documentation. So we're getting pay stubs, W-2s, bank statements, copy of the credit report, and we're vetting that information and reviewing it before we'll even issue the pre-approval letter. So the terminology that gets thrown around, almost nobody uses the term pre-qualification anymore. Because everyone's a pre-approval, but there's varying degrees of that, as I was just mentioning, where a lot of lenders aren't even looking at documentation. They're just taking the client's word for it. And so that's where this point that Mike has in the slideshow about having an incorrect pre-approval. I don't know about you guys, but when I was reading that, I'm like, well, what's an incorrect pre-approval? And that's what it is. It's where they didn't actually verify any of the information that the client was telling them, and then they just issue a pre-approval letter, get a property under contract, and then all of a sudden everything falls apart. And that's obviously not good for the buyer. That's not good for you guys as real estate agents, because that impacts your reputation. Even though you had nothing to do with the financing, you were the one who presented the offer, right? And so that's another reason why, if you have the ability to be able to have a client work with us as your preferred partner, and obviously we've got that relationship, and we've earned your trust through many transactions over the years, months, whatnot, then that's going to be all the better for you guys and your reputation, because you'll know that when you get that pre-approval letter, that it's worth the piece of paper that it's printed on, because it came from us. So that's all I have on that.
Thank you, Kyle. I sent everyone an email with the handouts, just so you have them. I need to research that timeline one with the bankruptcies and foreclosure. So I'll do that and get that out in a separate email. What other thoughts or questions or feedback or conversation pieces do we have before we wrap up?
What are typical turnaround times to issue a pre-approval, assuming the client issues all the documents? And I'm sure it depends if you're like, how many loans you have in process, but typically.
Yeah, I mean,
It's more-
typically 24 hours.
Okay.
Yeah, I was going to say it's more dependent upon the client,
I was just gonna say
because
that too.
yeah, I mean, we could turn around a pre-approval, lickety split. I mean, same day if we had all the documentation, but usually we're waiting for the client to provide us with what we need, right? So we'll give them a basic list when we send them the link with the, for the mortgage application. We'll give them like a basic breakdown of like, hey, W-2s, pay stubs, bank statements, that kind of stuff. But, some clients will off and running, they'll do it right away. And other clients will take a week, even if we're following up on a consistent basis. So it really just depends, but the quicker the client can get us what we need, the faster we can turn around a pre-approval. Sometimes that's same day, sometimes it's next day, sometimes it's next week. It just depends on the client.
Perfect. Thanks.
Yeah, But to set your expectations, it would be 24 hours from when we receive the documents from the buyer.
Makes sense.
Give us some time to review it.
Thanks.
You're welcome.
Actually, one more thing I think we should mention is another value add as far as what our company is capable of doing is we can take that pre-approval that the loan officer issued and actually turn it into a fully underwritten pre-approval by submitting it to our underwriting department and have them review it even without having a property under contract. So at that point, that pre-approval, basically, it's almost like having a cash deal because it's already been fully underwritten by the underwriter. So the borrower has been fully approved and all we have to do is approve the property, meaning, getting an appraisal, or maybe we'll get lucky and get an appraisal waiver, but getting an appraisal, getting the title commitment taken care of, and then we're able to wrap up that loan. And so, that is an option. We don't do it a lot just because, the market's moving so fast that, sometimes we just don't have the opportunity to do that from the time that we are introduced to the client from you guys to when you get them under contract, which is great. But it is an option. And so, Mike had mentioned on the Q&A call yesterday, for those of you who were on there, this will be repetitious, but, on like an FHA loan, for example, it might be a great opportunity to have somebody go through the fully underwritten pre-approval process with an FHA loan so that that offer is very competitive. You can say to the listing agent, hey, yeah, they have a FHA pre-approval, but they're actually fully approved. Like they've been underwritten by a human. And, so this is better than just a regular pre-approval. They've already gotten their, the buyer's already approved and ready to go. So it could put you in a better, more competitive, situation when you're presenting that offer, even if it's not a conventional offer. So I thought that was a good point that Mike made yesterday on the Q&A call, that it's something that we have the capability to do for you guys.
Yeah, I think Gabby and Yanni are going to start doing that more based on our call yesterday. Makes your offer stronger. Anybody else? Kyle Can? Got any jokes for us?
He's on a call.
Yeah, okay, no problem. Anybody else? Courtney, anything you want to share? Sherry? I didn't hear from my dear Sherry at all on this call. What's the deal with that? That is very unusual.
You weren't talking about bowling. That's fine.
All right, guys. Well, listen, I'm going to wrap this up then. Thank you all for being on the call. I really appreciate your time here, and hopefully this was worthwhile and you found some value in this. We will continue to do stuff like this as time goes on, and knowledge is power. So if you all have any ideas around trainings that you'd like to hear or to learn about, please email us, ping us on Slack, like tell us what you need and want, because we will make a training around it and we're happy to do it. So look forward to your feedback if and when that is provided. Okay.
Oh, Mike, I mean, we can cover this on the next one, but I was just wondering for student loan debts. I heard like it would, and I think we covered this on a prior meeting about using half of their debt amount or something like that.
Yeah, Kyle, you want to handle that one?
Yeah, so it depends on the investor. So for FHA and Fannie Mae, which is one of the conventional investors, if they do not have a payment, like a lot of people have student loans that are in deferment right now because of COVID, and they just automatically went to deferment. So if somebody doesn't have a payment being reported on their credit report, we still have to calculate a monthly payment to recognize that obligation. Okay. So on Fannie Mae and Fannie Mae and FHA, we have to use 1% of the outstanding balance. For Freddie Mac, we are allowed to use 1/2 of 1% for the outstanding balance. So it could be advantageous to select, if we're picking conventional investors, it might be advantageous to use Freddie Mac because we can hit them with less of a monthly debt for the student loans compared to Fannie Mae. And so that might steer which investor we choose to, to place their loan with, and be able to get them the best terms possible based on their situation.
Yeah. FHA is a 0.5% now as well.
Oh, okay. Sorry. So it's FHA and Freddie are 0.5% versus Fannie, which is still 1% at this point.
So that comes in huge when, like we're talking to somebody that's going through nursing school or getting their doctorate or something. I mean, I'm doing a loan right now for a lawyer, and she's, fairly new into her practice. She's been in it for 2 years. Well, she's got $175,000 in student debts, right? So, 0.5% of that versus 1% is very different. There's also ways that we can do what's called a income-based repayment plan, which could sometimes be a much lower payment, which is what I did for her. That can be negotiated with her student loan company and get an even lower payment for the qualification. That's a bit technical, but that's something that we can do as well.
That was awesome. Thank you.
Sure. All right, guys. Well, enjoy the weekend. Go Bills. And I will talk to you guys soon.
Nope. Go Patriots. Nope.
See you guys. Have a good weekend.
Patriots.
Thank you.
Thank you, Mike and
See you later.
Kyle.
Thank you.
You're welcome, guys. Have a good weekend.
Bye.
You too. Bye.